So, welcome to the last lecture. Just to really torture you very hard, I'm going to do something very bad. I have 4 papers to present. I'm not going to do that actually. So I will have a lot of slides, but I will pick a few of these depending on what you ask and how it works. It's going to be about politics and banking. It's a topic that's usually not related, but I think should be related, because I think these two things are very much connected. There's a lot of papers on political economy, there's a lot of papers on banking, and usually they are not so much connected. But we see today there's a literature emerging that tries to connect these both literatures. I will show you a few papers that do this in general, and then I will talk about Russia, because I've been working on Russia and I have a number of papers that try to connect these things. One of these papers is very fresh, and so that paper needs feedback, so if you have any ideas, please go. But this is the larger framework of my talk. And this is from Buchanan and Tulloch. It goes back to a long time. So basically what I'm talking about is public policy. And politics is just one way of doing public policy. And usually in public policy, somebody wants a policy, somebody supplies a policy. And there's some policy issue. The policy issue in our case could be, for example, bank stability or bank regulation or something like this. Or capital regulation more specifically. But it's a more general thing. And we'll look first at the general thing. And so basically, the demanders could be many guys. Could be a specific firm. A specific firm that wants some exception from a rule. Or wants a rule to protect her. Or some non-governmental organizations, activists that lobby for some, for example, environmental regulation. Or it could be other firms that say, oh, this one firm protects herself, has a monopoly, because of this regulation, I want the regulation skipped. So private special interest groups want a policy, want a regulation, want the policymakers to change something. And then there are suppliers. Suppliers are not only politicians, that's a big mistake. A lot of the stuff in terms of public policy is decided not by elected officials, but by regulators. You could call them also bureaucrats, people that are not elected, but have some position of power in any country. Or there could be courts. A few people here actually work on courts, like Lena. So it could be courts that decide on public policies. And there's going to be a medium of exchange. So, okay, I will get a public policy. What do I give in return? And if it's an elected official, it could be, for example, votes. It could be money. In that case, we call it a bribe. It could be information. It could be other things. So basically, you have a political market on some policy. And there's an exchange between demand and supply. And it's in this larger framework we will be situated. There's special interest groups, there's political strategy, and there are political institutions. And we will look at financial institutions as a special interest group. We will look at elected officials. Actually, not only, in fact, I will show you why, but to some extent. And we will look at direct political connections as much as we can. That's the idea of the talk. Okay. Yeah. So this goes back not so long actually. It's a new literature, and it started really only in 2001. So that's not so long ago. There's a seminal paper by Fisman. Fisman has many seminal papers. That's one of them, and he looks at the Suharto regime. And at some point there were rumors about Suharto being ill, and at that point all the firms that were clearly connected to the Suharto regime on the stock exchange, they tanked. The stock values went down. And this was like a stock market measurement of the value of political connections. So what they did is, in some way, they measured the political connection and they show the value by, so what happens, Suharto gets sick. So the idea of the market is, okay, the connection will disappear. And you can then measure the value of the connection by the decrease in the value. And this is the first time they showed it. And after that, it has been shown in many, many cases. This Italian guy, Faccio, I don't know how you... Faccio, grazie. So Faccio shows this for a cross-country sample of listed firms, many firms, in many countries. And it seems to be true everywhere. It's uniformly true. That there is some kind of a positive effect of political connections. It's not true with the same extent everywhere, but the sign is the same everywhere. So there seems to be value of political connections, which is kind of cool. Now that makes you think about why. And the reason is this. There's many papers, I'm not going to go over all of these, you will get the slides, but there's many mechanisms why connections are useful. I'm not going to explain all these papers, but I'm just going to say a few things here and there. So one typical one, a very old one, is relaxed oversight. So one reason why you could want the connection is then the government, the monitor, the auditor, whatever it is going to be more relaxed. I'm going to get away with more bad stuff without someone punishing me. And that's because I have connection. The most simplest way to say this is, I can drive too fast, get tickets, and never pay them. That's a simple way, right? And we know these stories. But on a more large way, firms can drive too fast and not get penalized, right? They get away with stuff they shouldn't do. This is the biggest one. And many of the others kind of fall into that range. You have soft budget constraints, so basically I have a connection with the government, my firm is doing very badly, I'm getting refinanced. I'm getting subsidies, I'm getting extra loans. So we all know these stories, right? In Russia, that's very, very appropriate to talk about this. In Russia, subsidies are big, and you have many, many state-financed enterprises. And of course, this is linked to political connections. But this is true in any country, as a matter of fact, not only in Russia. You have access to government contracts that relates to public procurement. Maybe you have a connection to the government. And there's a famous paper, of course, of Bironov and Zhuravskaya on this, that shows that there's in procurement in Russia, that there is a political connection story. So there's a lot of channels. We can talk, all of these are worth a talk by themselves. So if you're interested in this, you can look at the literature. If you look at banks, because that's the topic of today, why would banks want it? Well, the interesting thing is banks are probably, especially today, the most heavily regulated sector in the world. The amount of compliance they have to do because of they fucked up so badly in 2008 is tremendous. Many small banks are really dying. Small banks are really suffering. And even big banks like Deutsche Bank are having serious trouble to survive the new oversight. The capital rules, liquidity rules, leverage rules, but also all kinds of limitations, all kinds of things. All kinds of rules about how they deal with customers, onboarding to avoid money laundering, checks on how they sell things to customers in the MiFID. It's a lot of regulation. There's probably only one sector that is more heavily regulated, that's nuclear energy, and even there, it's not clear they're more heavily regulated nowadays. And the reason is in the end the same, right? The reason why they're so heavily regulated, these both sectors, is externalities mainly. If the banking sector would collapse, everybody will suffer. So there's huge externalities, and that's why they have so much oversight. You could argue we shouldn't do that, let them die, but we know from practice that if too many die at the same time, even in a very free market country, you will have to save them or do something. Because otherwise the whole economy will collapse, basically. So, okay. The second reason is, of course, information asymmetries. The same in nuclear as in banking. Many of the regulations are ultimately driven by this reasoning. There's a lot of small investors, small depositors that are in these banks. They can never understand what this bank is doing. It's too complex. If you want to have systemic stability, avoid bank runs, these are the guys you need to protect. These are the two big reasons. Systemic stability and asymmetric information, essentially. And they are linked, obviously. So, would banks like to have a political strategy at the banking sector level? Of course they would, because they have a lot of regulations and rules coming to them. And they want to talk to the government and say, no, that's not good. We can't do this. It's too heavy, it's too costly, it's impossible, this kind of stuff. We're not going to be efficient. Huh? So there's a massive lobbying campaign in banking to make the rules more relaxed. Actually, if you go back to theory, it's very logical. You see that there's a whole literature on government capture. What is the likelihood that the government will be captured so that government decisions will be driven by private interest? And you see that in theory, this has to do with the nature of the industry. It's much more attractive for private sectors to capture a government if they are very concentrated, a few firms, and heavily regulated, which is clearly the case for banking increasingly, or oligopolistic, which is close to concentrated but not the same. And banking is one of these sectors, obviously. You see, even after 2008, an increasing consolidation, more and more, which is a problem, I think. Banks are doing more and more the same thing, also less diversity, and they're more heavily regulated. So they have all the reasons to do lobbying, to try to capture the regulation. And you see, there's many, many examples of this in the past, and there will be many in the future where banks try to steer the regulation. And of course, the government tries to fight back, and it's a never-ending fight. Maybe sometimes regulation is perverted. So some people argue that today regulation is too complex, and that's to the advantage of the big banks and to the detriment, to the cost of the small banks. And some people say it would be better to have very simple regulation, but harsher. Instead of saying all these complex capital rules, say they need a leverage of at least 6 or 7%. Raw capital in total liabilities. And forget about all the rest. But that would be very expensive for big banks and not for small banks. So the big banks won't have it. They prefer the complexity, actually, because it's good for them. Forget about this stuff. So the question is also, is there something like this, right? But is this money is exchanged for laws? This is money, this is a law, right? So are people, do we capture the government? Do we create regulations, laws in our favor in exchange for some bribe or something else? And it's a good question to ask. One application could be, for example, deposit insurance. There's a famous paper in the Journal of Financial Intermediation that shows that the introduction of deposit insurance schemes is linked to a story of capture in a way. So you see that it's mainly banks with poorly capitalized banks. So let me put it differently. The probability that the country introduces deposit insurance at some point in time is strongly linked to, at that point in time, the capitalization of their banking system. Because deposit insurance is a kind of free insurance for banks that protects banks, actually, in some way. And which banks seem to do it? Which banking systems seem to do it? Those that are poorly capitalized. So those for whom it's most beneficial, the insurance, in a way. You also see, for example, I mean, this is a theory that was being published in 2008. They were very topical because, of course, they wrote the paper not in 2008, they wrote it before. But what do we see in US and Europe after the crisis, when it turned out that banks were very weakly capitalized, there was a crisis, we increased deposit insurance, very much in line with the theory. That was some capture. I mean, it's very clear that at the moment all the banks crashed, the banks massively start calling the government, please increase deposit insurance, right? And all governments complied and coordinated. You have the same in Russia. It was introduced in 2004, crisis. It was increased in 2008, crisis. It was increased again in 2014, crisis. That's what we do, right? So basically, this is a very strange insurance. Usually insurance is as follows. I pay some kind of fees, insurance fees, and then something goes wrong, I get a payout. But how does it work here? So I drive with my car for free, then with my car I hit the wall. And then the insurance company says, okay, I will pay out, and from now on you have to pay fees. The fees are too low, because the next time I hit the wall, they say, oh, I will pay out again, and later on I will increase the fees a bit more. So it's like a reverse insurance. It's like an ex-post insurance in a way. Because ex-post, they always increase it when it's needed. So basically, that means that there is a kind of a strange game. People say that in the end what you construct is something like the bank takes a risk and it goes well, the bank wins. The bank takes a risk and it goes wrong, well, the government pays. That's in the end the thing. So this is moral hazard. It creates moral hazard. It's been shown in a very old paper. We know this for a long time, and it's been reaffirmed time and time again. We know, so if you make a model where you try to predict a banking crisis, what is the likelihood that a certain country at a certain point in time will go to a banking crisis? One of the biggest predictors is deposit insurance. So if you introduce deposit insurance in the wrong way, so there's a number, so you can look at how is it funded, are the fees risk-based or not. So if you introduce deposit insurance too high in the wrong way, it just increases systemic instability. Because so imagine you're all banks, and I give you deposit insurance. What happens? The first thing that happens is you depositors do not care about your capital. Because if it goes wrong, they have insurance. They don't care about your liquidity. Because it goes wrong, you have insurance. Because depositors don't care, you have change incentives. You take more risk. Ultimately, if the risk goes well, you have high return on equity. If the risk goes wrong, deposit insurance will pay for your depositors. That's the moral hazard story. Because of this, that's the mechanism, because of that reason, banks do exactly this, you end up to have more systemic risk. Because the banks individually all take more risk, so collectively you have more banking crisis. So basically the optimal solution would be like constructive ambiguity, theoretically. You have to increase deposit insurance and the crisis time to prevent the crisis, and then you should decrease it again. People should worry a bit about their banks. Because if nobody worries about their banks, banks do whatever, and then that's why it goes wrong. The worry is good. Worry is good to some extent. It keeps them awake, right? Okay, I'll skip this, but this is kind of obvious. You have individual banks that also lobby. I mean, let me give you one example, the famous example of Goldman Sachs, right? So you have individual banks that try to capture the government. So Goldman Sachs is famous for that. For example, Draghi at ECB is from Goldman Sachs. That's a big story. Hank Paulson, who was the guy who had to save all the American banks in 2008, who invented TARP to some extent, the program to save the American banks, he was former chairman of Goldman Sachs. Draghi too, chairman in Europe. So you have people at individual banks getting into positions of government and monetary policy and regulator, which is actually very strange. Some people argue, yes, but they have the competence and the connections, but of course it's also tricky. And this is true in any country. So you have these stories of revolving doors. Revolving doors means that people from a bank go into the government or the other way around. That's a big problem. And you can talk about this a whole hour by itself also. All the scandals that have happened in European or American history, it's massive. So individual banks also at the bank level try to get connections to the government. One typical way is, for example, there's something we did in Turkey. Some banks put former politicians at the head of the bank. You know this also in Russia, right? So former politicians all at once become a top banker. Think of Herman Gref, is one example, for example. So this is a typical thing we do. What is the problem with this? Okay, if a former politician comes as the director, CEO, chairman of the board of a bank, basically what the bank is buying a connection. So this bank is going to have some implicit protection, and everybody knows. Because of this, this bank will attract more depositors, more funding, at a cheaper cost, because everybody knows this bank will not go bankrupt. Because Mr. Graf is at the helm, and he's well connected. And in Belgium it's the same. In Belgium, when Dexia failed, they put Jean-Luc Dehaene at the top of the bank, the former prime minister. They did the same thing in the Netherlands. When ABN AMRO failed, Gerrit Salm became the chairman and at some point the CEO, which was the former minister of finance. And these banks don't do necessarily better. Actually, Dexia did very badly. But what you do by putting a politician there is buying a connection. It happens in every country. So there's many ways why this would be important. Access to cheaper funding, as I said, but you can deal with some kind of legislation and burdens. There's regulatory forbearance, so you can get away with violating the rules and not being punished. It's something we show in an old paper for Russia, actually. So there's many reasons why individual banks would do this. So this is Hank Paulson saying, we need to do TARP. That's what he was saying at that moment. Actually. You have to do TARP, you have to save all the banks, or the whole American economy will go down the drain, convincing Congress that they should save the banks. He was right, actually, but for the wrong reason, possibly. Okay. So basically what I'm saying is, what I'm talking about until now is the helping hand hypothesis. It's the government helping the bank. But of course, there's also something else. It could be the bank helping the government. That's a grabbing hand. We'll talk about the grabbing hand in a while. But we're still talking about the helping hand. Many of these stories I already told you, basically. Sberbank in Russia also. We have something on Turkey. But let me just talk about the amakaduri. This is like a fun story. What does amakaduri mean in Japanese? It means descent from heaven. So basically, sent down from heaven. And what happens in Japan, at least until 10 years ago, is that the top position you could have in Japan is being one of the top bureaucrats in the Ministry of Finance. It's the most important, powerful ministry. And what happens, these guys, at the end of their career, they descend from heaven and become the chairman of a bank. Now think what this means. The Ministry of Finance in Japan has to do the oversight. Somebody in that ministry does the oversight on the banks. And now all at once, some guy in the ministry has to kind of supervise his former boss, who is now the chairman of the bank. How good will the oversight be? Especially in Japan, which is a very, very hierarchical society. There's no oversight at all. It's just a connection. So that's one of the reasons why the banking system in Japan 17 years ago so spectacularly failed and is still in tatters today in a sense. And they never really fully recovered from that crisis. And it's a lot to do with political connections in the banking system. So what I'm talking about, if you look at it properly, you see it's everywhere in banking. It's everywhere. But there's very little research about it, which is peculiar, I would say. You have the same in the United States, actually. TARP. TARP stands for Troubled Asset Relief Program. Within TARP, you have a sub-program, the CCP program. And that program was essentially banks could apply, and then they were bailed out. They got capital support from the government. So basically, it's a bailout of banks. Banks have not enough capital, and we bail them out with certain conditions. As long as they don't pay back, they cannot pay dividends, they cannot pay bonuses, and so on. What do we see? We see who is receiving TARP? Well, politically engaged banks. Banks that pay money into political campaigns, do political contributions. They're more likely to receive TARP. They receive more TARP if they receive it. And they receive it earlier. United States. I'm not talking about Russia here, right? United States. So political connections matter. You also see that banks respond to that. They respond by taking more risk. So again, you have the moral hazard story here. I know I'm connected. I know I can take more risk. Because if I take more risk, I will be bailed out. And because of this, we take more risk. Right? I'm writing a paper I'm not going to talk about here on the effects of TARP today. Long-run effects of TARP. Which brings us to the grabbing hand. This is going to be the Russia story. Russia is not so much about the helping hand, it's about the grabbing hand. It's politicians using banks, not banks using politicians. Banks do use politicians too in Russia, but more the other way around. There's a famous paper in France that basically shows, for companies, that politicians also use the companies. So basically what you see in France that if you look at regional variation, you see that the state-owned enterprises, the politically connected enterprises, I could say. So in France you have the system of les énarques. Les énarques are people that go to a few schools, highly elitist schools, and they become all the CEOs in all the big companies, especially the state companies. And so they have a political connection. You know to which party they belong, essentially. And you can show that these people, these CEOs, politically connected CEOs, before elections, what do? They do not close any plans, they create more jobs in the plans, and especially if it's in politically contested area. So if there's an arrondissement in France, like an oblast, which is very highly contested, it's like on the limit, winning or not, you see that if there is a politically connected CEO there, he increases jobs, certainly doesn't close any companies, just to basically fuel the local economy and raise support for the incumbent, for his party. Not Russia, France. So these things happen. Okay. Now, which brings us to my topic of today, which I will talk about a lot, which is the seminal work of Dinç. And Dinç, a Turkish guy, I probably pronounced it wrongly. I apologize for any Turkish-speaking people here. Is anyone actually? Probably Diaz a bit. I don't know. So what he showed is, in the paper, a very simple idea. So elections happen over time. And what he showed is within countries, if you compare state banks to state-owned banks, you see that before elections, the state banks increase the lending much more than the private banks, and decreasing again after the election. So basically what the state banks do is before elections, by raising credit and probably fueling economic activity and creating more jobs, they try to make the incumbents more popular. They try to raise support for the ruling party. You see this in all countries. You see it even in OECD countries. It's more in non-OECD countries, but also in OECD countries. So basically what they show is the first guys to show a political cycle in credit, bank credit. Not the political cycle in public procurement or government spending. It's a political cycle in bank credit, especially from state-owned banks. But this is a cross-section. And it's cross-country, most important. No, it's not a cross-section, it's cross-country, I'm sorry. It's over time, but it's a cross-country. Basically, what you could do is you could test these kind of things in Russia in several ways. And that's what I will try to do with you today. The grabbing hand. Okay. By the way, there's a recent paper in 2016 in Germany that shows it is true in Germany. In Germany, in every state, they call them Länder. You have state banks, owned and dominated by the local governments, and cooperative banks, which are owned by the people, you could say. And they show exactly the same pattern. Within Germany, within the state, you see that the state banks, so the government-dominated banks, compared to the cooperative banks in the same state, the Länder, increase lending before elections. They also show it happens more if the election is contested. And they show that after the election, these guys have more bad loans. So the increasing lending before the election, you could say, yes, they increase lending because there's more economic growth, things are going better, but they show that after the election, there's more bad loans. So these are politically motivated loans to rally support for politicians and that go wrong after the election. And there's a lot, so in Germany, they have many problems in the banking system. Deutsche Bank is one of them. That's a huge problem. But there's also, Germany has more than 2,000 very small banks, actually more close to 3,000. And many of them are these cooperative and Länder banks. And they behave in a very political way. So it can be stable, but it's also tricky. It's also very tricky and could lead to crisis. So basically, what we're essentially saying is, you have the grabbing hand and the helping hand. You have political connections and banking, and it happens in all countries. Just we never talk about it much in the newspapers, but it's not only Russia, it's everywhere. But also in Russia. I'll skip this. I will talk about the first paper. This is one that is published, and basically what we show in this paper is it's a Soviet story. So for the historians among you, so I will present 4 papers, but I will just present the idea and a few slides. Not to go to all the identification stuff, all the details, just to give you ideas of what you could do with Russian data. Russia is very cool. There's a lot of stuff you can do in Russia. I trust that if you start writing the paper, you will go do the econometrics, you will do the model, you will do the identification, you have to do all that stuff. But I'm not going to talk about that. We can talk about this in consultations, but I'm going to talk about the idea. So basically my idea was the following. Okay, in the Soviet Union, you had these state banks. Promsterbank, Bank, Agroprom, Bank, and so on. And the question is, what happens to these guys? What you see if you go to the archives is that Agroprom, Gilsot, and Promsterbank, they kind of exploded in more than 800 private banks, often with a very new name. So also some actually Vnester banks did it, a few. So the surviving banks are Sberbank and Vnester Bank, most of it. But the 3 other banks and part of Vnester Bank exploded a number of private banks. These private banks, how did they look like? Well, the former clients, state-owned enterprises that later were privatized, became the new owners. So the people that you lend to become your owners. The management maintained, stayed to be the old management of Soviet times. They just carried it on. So basically what they did is they privatized a local department and registered a local department as an independent bank in a very successionist, spontaneous, chaotic period, the late perestroika period. And what we show is that Russian regions that have more of these banks have more lending growth, but less economic growth. And the reason is that these banks, because of the old political connections, keep lending more of their money to old privatized enterprises, often monogords, that kind of linger on but don't grow, and lend less to new firms and to high growth firms, which creates social stability, but less economic growth. So basically what they do is zombie lending. That's a name from Japan, actually. Zombie lending was invented for the Japanese crisis, but it's happening also in Russia. How did I do that? So I will not show any regressions even. I will just show you a few pictures in this case. So what is this? Every dot is a Russian region. It's just a scatter plot. This is how many Spetsbanks you have per million of the population. In '95, this is archive work. I did this myself. 2,000 pages, writing it down, very interesting. So some pain is necessary if you want to do good academic work. Pain is good. It's right, pain is good. You have to suffer some pain. You don't say, oh, it's hard. Of course it's hard. That's why it will publish well. If it's easy, someone would have done it already, right? It has to be hard. And this is the increasing lending. And you see, if anything, it's a positive correlation. It's certainly not negative. So more Spetsbanks is more lending. So basically we wrote a paper which idea, we're going to be the first paper to show that finance, the causal link between finance and growth. And our idea was we have an exogenous source of finance, this Spetsbank privatization, because the state bank system was not put there for future market growth, it was put there for Soviet reasons. But it didn't work. Fuck. We find something completely different, so we had to think about the story. So what do we do then? Look, all these guys, split them down the median, like the high and the low Spetsbanks. So the median would be somewhere here, split this group in this group and this group. And then look at the increasing lending year per year. Because this is the increasing lending over a period. The next slide you go year per year, and we split the group in the high and the low. The red guys are the high ones, the one in the previous slide on the right. And the circles are the low ones. And you see that they start at the same point, and you see real divergence. You see that the high Spetsbank regions have more lending growth. So we thought, yes, our instrument works, and now we're going to show they grow more. They don't. If anything, it's negative. If anything, it's negative. In the regressions, it shows up negative. Damn it. And there's no divergence. Completely parallel. I mean, if you have ever seen a parallel trend, this is a parallel trend, right? You could move it up, it's exactly the same. You say, Jesus Christ. You spent like half a year doing this archive work, and then you find this. You say, oh, really? Okay. So the first instinct was, I'm going to ditch this project. I never want to see it again. I hate it. But then we saw some interesting things. So I went back to the archives, full of frustration, and then I start looking at who are the directors, and can I track them down? And you find we could find it for 99 Spetsbanks and 146 other banks. It's hard to find this for everybody. In '95 was a murky period. You see that these Spetsbanks, so these former Soviet banks, look at the directors. More than 3/4 are politically connected, while only 1/4 for the private banks. Whoa, these guys are connected. Look at the general director. This is the CEO, 90%. Whoa. The Glavny Buchalter, 85%. These guys are politically connected. So if this is true, then we thought, okay, maybe we should look at unemployment and stuff like that. We just look at director by director, and basically what we could track down is whether they already worked in the Soviet banking system before '92. Because that meant they had connections to the old firm state enterprises. That's the way we do it. This is the paper. The paper goes on a lot longer and a lot of empirical stuff and questions and referee stuff and robustness and all that. We do all that stuff. But what we show in the paper is, you see this, okay, and you show that actually those banks, they do not lead to more growth. But if you run it on unemployment, it leads to less unemployment. So what they do, they lend to companies to keep employment stable. They lend to their own buddies. You also see that there's less new SME developments. So less new firms are started in these regions with a lot of these banks. So you see that like the old system is continued a bit in a sense. And you also see that, that this idea that the old system continues, lingers on, is especially true in those regions with bad institutions. Actually, in those regions with good institutions, we can show that there is an increase in economic growth. So basically the exogenous lending, the Staatsbank lending, on average didn't work. But if you then look at heterogeneous effect, you see it actually did work in the good regions, where there are very quickly reformed institutions. And it worked very badly in the bad regions. So there's also an institutional story in this paper. But I'm not, and this is a lot of tables which I'm not going to show. I'm just asking you, believe me, read the paper. So that's paper one. Haha. I'm going to do these 4 papers actually. I'm just going to tell you the story. Paper 2 I showed you the paper of Stowasser and Engelmeyer in Germany, and I explained you the paper of Dinch, political cycles in lending. Right. This is an application to Russia. It's application to Russia. So basically what we're saying is, before elections, there's more lending, and because of this, some guy is elected from state banks. That's the broader story around the world. Now, we're going to tell the story in Russia with the election of Putin. And the question is, was Putin elected? Yes, of course he was elected in 2000. But in 2000, there were no issues about electoral difficulties. There was no other, there was still media competition, and TV was still alive as an independent television station. So basically, Putin was really elected, and people ask why. And it's actually amazing, because in not more than 3 months, his popularity soared from 23% to more than 50% in every region. As a politician, that's really neat. If you can increase your popularity so fast, so quickly. Remember, this is before all the good stuff he did, and the bad stuff he did maybe, right? But he was he was prime minister, and he had a very small track record. Nobody knew him. So how could he raise his popularity so fast in a few months? For the people that don't know Russia very well, he was prime minister from July on. In New Year, 99, Yeltsin abdicated. Yeltsin was the president, he abdicated, and he became acting president. In December of 99, there was an election. And we have the data, so we know exactly how popular the party of Putin was in December 99. By end 99, he becomes acting president. You can't be acting president forever, so you need to have elections. They had elections in March, 3 months later. And in March, all at once, he jumps from 23 in December 99 to more than 50% in every region. And so we tried to explain this jump. That's it. So this is Yeltsin saying, I'm going. Everybody was shocked, except, of course, some people. Putin knew. I mean, even in the biographies of Putin, Putin talks about the spirits and talks about how Yeltsin talked to him, I will abdicate, do you want to be the new president, and I think you should do it. And so this was coordinated. Of course Putin knew. And the people in the system knew, but the population didn't. The population was like, what? What is this? So that's the question. That's the question, right? Don't you want to know this? I mean, our explanation is very partial. Of course, we don't tell the whole story. Many things are going on. You had the Chechen war, and that's also probably playing a role, like patriotism. But what we basically claim is we have part of the explanation. And part of the explanation, interestingly, is banking. It's banking, folks. Banking is so cool. So we look at Sberbank. And Sberbank at that time was by far the biggest bank. By far the biggest bank. It had majority of depositors and deposits. It was the largest lender, individual lender to firms and households. So now it's even bigger, but then it really was already a very big bank. Actually, it had been very big in 92. It then disappeared a bit. Then it came back by 98. because of the '98 crisis, many people started to distrust private banks and then back to Sberbank. And by '99 it was very big again. And what is the mechanism we're thinking about? This is called workplace voter mobilization. Many people in Moscow don't believe this because they think it doesn't happen. But I'm not talking about Moscow, right? I'm talking about the whole country. And in many places in Russia, from Soviet times on, it was a tradition that managers of enterprises were kind of responsible to getting out the vote for in the elections, in the communist elections. And many guys still do this. So what happens in many firms is that the management gives workers incentives and clear indications of who's the right guy to vote for. People, of course, are still free to vote for whom they want, but they get a clear guidance. And basically, the hypothesis is that at the moment that that Putin knew he had to become president, before we knew, what they did is they called the governors. They knew. They say, okay, we have to do this. You have to convince all these state enterprises that the workers vote for me, or the privatized enterprises. Okay, how can I convince them? Well, I will send Sberbank credits. So the mechanism is, we know this, we send Sberbank credits to the firms, because they get these credits, that's the quid pro quo, tell the workers to vote for the right guy. That's the story. Okay. I mean, this is actually not an issue, a point of discussion. This is one paper, but there's actually more than 50 papers that talk about political mobilization in the workplace in Russia. And actually, there's also even some literature in the US. In the US, in some states, some politically connected directors do it too, and send emails to the workers for whom they should vote. So this kind of mobilization on the workplace of voters is not something that's peculiar to Russia, but in Russia it's especially strong because of the Soviet inheritance, you could say. People know it, okay? So, and the reasons why it's really interesting in 2000 is, after 2000, Putin has sticks. You can't tell companies credibly you have to behave, and you can't tell to governments credibly you have to behave, otherwise you will not be reappointed. So after 2000 he's so strong, he doesn't need us, he can do many different things. But before 2000, the election was very close actually. And Unity, remember, in December '99 only got 22%. At Czechoslovakia, the competition got 24%. They were not even the biggest party actually. And the competition was Lushkov, Primakov. Lushkov was mayor of Moscow. There was serious competition initially. So he needed something to pull off the trick, right? And what we say, it's the banks. So what is the underlying identification idea? Okay. So first of all, okay, I will first show I'll do this and then I will go back. So what we do is, we look by region. So we have regional variation. And by region, we look at the vote in March 2000 minus the vote in December '99. So it's the increase in support for Putin in this 3 months. And we run this on a whole load of control variables, but also on these ones. So the change in Sberbank firm loans, so we have Sberbank data, and we have Sberbank data by month and by region and by type of credit. So we know for every month how much credit Sberbank gives to firms in a certain region, and actually to households in a certain region, which is really nice. It's data you usually don't have. So it's great for identification. So we know the change over some period before the election in Sberbank firm loans, in Sberbank household loans, and in private domestic banks loans, which is cool. By looking at Sberbank firm and household loans, you can back out the mechanism. It's through the state enterprises. It's not through households. It's not some regional Sberbank, whatever, they got more deposits and so they lend more. Because then you would also see it in the households. It's not some regional economic growth. Maybe people say yes, but those regions could expect more if Putin is elected and they grow more and that's why they get more credit. Because then you would also see credit from the private banks. And that's how we control for it. So these are the underlying identification ideas. We have within country, within bank variation. The other papers, the competition you could say, they basically have a cross country. They look at the country level, not at the bank level or the within bank level. So we have much more detailed variation. We have monthly, the other guys have yearly data. So the election, if the election is in the middle of the year, well, what do you do, right? Elections usually are in the middle of the year. So they have to take a year before. We can do the months before. It's very specific. Look at firm credits, not household credits. So you have the company channel. You control for the private stuff, as I explained already. You can have regional controls to look whether some other drivers of political polarity could drive in it. And you have placebos. You could say, okay, the relation between the surge in regionals leading to firms and the surge in popularity should only be there in the months before the election. But if I take a surge in credit and any other period before or after, there should be no correlation. It should be there only in that period, right? Okay, so that's what you find. So the increase in lending on November, December, and December, January is positively related to the increase in votes by March. You have to understand that in this period, getting a credit arrive in the destination took almost a month. The payment system was very inefficient, not digitalized. And then, of course, you need to use the credit. The region needs to use the credit to convince the managers to get people out to vote. So you need some time for the channel to work. It's there in the period before. So it is, remember, we insist on this, right? Alpha 1. Alpha 1 should be positive. And should be positive only in the months before the election. So that's what we have here. It's positive. And look the elections before. Nothing. It's not there. Look at the elections after. Nothing. It's not there. It's only in the period before. Okay. That's the main idea of the paper. Of course, we do again a ton of publishing text. We've got many comments. So we look at monogorids, look at is it really state firms or non-state firms. There's many additional things we do. I will not talk about, but I will talk about two things that are especially convincing, I would say. The first thing is, if this is right, if it is about mobilizing people to go to the ballot, to go to vote, if this is true, what should we see? We should see that turnout goes up. Turnout is the amount of people that came to vote. So we should see that those regions that have a surge in credits, the 3 months before the election, also see a surge in turnout. More people will go to vote. Because that's the mechanism. You tell people that another said, okay, whatever, you have to go to vote and vote for this guy. So what you could do, you could just do the same regression as we did here, this one, but change the dependent variable from the change in the votes to the change in the turnout. You have the regional turnout in the December 99 Duma election, and you have the regional turnout in the March 2000 presidential election. Look at the change, and you see whether this is driven by the change in credit, right? So this is it. This is what we do, right? Just change this one. New dependent variable, same regression. What you see, bang. It's there again. And only in that the period we care about, like 1-2 months before that election. So, wow, this is kind of cool. And you see also our square really jump up, actually. Same with the previous regressions. So something changed in those months and it really explains the pattern. So that's very consistent. We thought especially, this is probably forthcoming in post-Soviet affairs. We shall see. So this is like a top area studies journal. So Russia is interesting. You can work on Russia and publish. That's also my message, right? There's many interesting things you can do. A second one we look at is connected leaders, regionally connected leaders. If the story is true, it should be especially strong. So how do you, this is the story, some people talked about this. It's about political machines. How do you do this mobilization of voters? It's local political, you talked about this, Dima, local political machines, right? So how can you mobilize the local political machine? Our idea was, they need connections with Putin. The governor needs to be connected. Putin is not yet the president. He could become the president. It's far from certain at that moment. It seems strange for you guys to imagine, but then it was far from certain. It was really competitive. So he needed connected governors to mobilize their political machines. Okay, who are the connections? Well, you could think of two connections. One connection could be someone who is appointed by Yeltsin, so that's a close relation with Yeltsin, and Yeltsin is connected to Putin. Or you could say it's someone from the Siloviki, someone who is from the security services or the army. There's many governors, I mean, this is all public information. They have their biographies, and some people say, I used to be in the secret services or the army. And you could imagine those guys are more connected to Putin, and those guys will mobilize their political machines to do what they're supposed to do, to motivate the managers of the firms to get out the votes. Is this a thing? Well, this is just from a different paper, not my paper. This is the Gorbachev 1988, 93 Yeltsin, 99 Yeltsin, and 2003 Putin. And this is leadership's categories, the national leadership like the National Security Council, the government, all the ministers, the regional elite, the governors of the regions, then the House of Parliament, and so on. And then you look at what is the percentage of military guys in these elite groups, and you see it goes up everywhere, from 5 to 50, more than 50, right? So I mean, we all know this story. I mean, it's not a secret story. This is a paper of more than 10 years ago. But also in the regional elites, you see there's an increase. And we actually in our data have 8%, in fact. So we come very close to this paper. And this is what you find. So we still have this is exactly the same coefficient as before. So basically these are to look first at the left. And the left is the same thing as before. And we look at, so basically we do Sberbank firm loans and then appointed governor and the interaction. That doesn't work. So connection to Yeltsin, no, that's not the story. Then we do the same thing to the right. Look here again, and we interact with Siloviki. Ho! Ho! What the hell? The main effect disappears. Actually, what we observed as the main effect was the average effect of regions where it doesn't happen and regions where it happens a lot. So the effect is 3 times as large in those regions where the governor is a Silovik. And in the other regions, actually, it's not there. So there is a story of using both the connections and this Sberbank money to convince workers to vote for Putin. We also have additional regressions going at these privatized enterprises, showing it's in these enterprises, not in the monogrowths, but I'm not going to talk about this. This is paper 2. Oh, and really like grilling your brain, right? Paper, another story, but it's all about Russia. So it means you can do stuff that's interesting on Russia. This is a paper which is very much in progress. I have 10 minutes, thank you so much. This is a paper that is very much in progress. I'm only going to show 3 slides, and I'm just floating an idea. But you have a model in mind. Actually, we have like an embryonic model that explains it. And the idea is the following. Okay, an autocrat, or like an electoral autocracy, like Russia. It's not an autocracy. Russia has elections. So we call it an electoral autocracy. It uses elections, but it's relatively centralized, right? Basically, electoral autocracies would want to limit media freedom. And this is true also in Hungary, it's true in Poland, it's true in Turkey. We see this in many, many countries. But they don't want to destroy all the free media, actually. They want to keep some of it open. And then you get a kind of game, right? So if I'm the autocrat, if I do only propaganda, nobody's going to believe it. So what I need to do is, in my channels, in my TV channels, and in my media channels, I have to say some truth. If everything I say is propaganda, nobody will believe it. People will disregard the channel, it's not going to work. So I have to partially tell the truth, partially tell not the truth. And we all know this. I know it, so I'm the media, and you know it. But the problem is, you don't know which part is the truth and which part is the lie. Right? And so, now the interesting thing is, you have, in Russia, you have, in '98, you have the big default, the banking crisis. But every bank had bank runs. It was very, very bad. I was here, it was very bad. Happy this period is over. And what we're basically saying is, okay, but some of these banks were exposed to propaganda, and the propaganda at the time is, I remember it's very vividly in my imagination, Yeltsin coming from a helicopter, from some meeting somewhere in the Far East, descending and getting out of the helicopter, being interviewed, and he was kind of wobbly, probably he was drunk, and he said, "Devaluacja nie будет." And the same evening, there was a devaluation, right? So basically, that's the point I'm trying to make. So the official media kept stressing, there will be no crisis, there will be no devaluation, the banks will be fine. At the same time, we had NTV being very critical about the banks. And what we wonder is this exposure to information in like an electoral autocracy, is it linked to bank stability? So what did we do? Actually, what did I do, unfortunately? All the banks in 98, what you can do in the archives, you can track down the address in 98. And then also NTV was based not on the cable, was based on antennae. So for every position of a bank in 98, especially for the small banks, you only take the small banks, depositors are close by. So you can calculate what is the strength at every location of a bank of the signal of NTV. And then you're going to see whether this signal strength explains the bank runs. And we have a whole lot of regression I'm just going to show you a figure. This is the NTV stuff, but I'm going to show you a figure. So the red guys, or the people, the banks where depositors are very unlikely to see NTV. And you see that the default was in August, right? You see that deposits increase, then you have the default. Yeah! These are the NTV guys. They start running a bit earlier, not a lot actually. But the main effect is they return. And they return in the long run. So the interesting effect, so we expected basically that NTV, so we thought, okay, the NTV guys will run and they create the banking crisis. But that's not the fact. They run a little bit early, but hardly. But the main effect seems to be that the NTV guys, they return. Why? Because they were watching TV and the TV was talking about the troubles. They expected it to happen. They were not totally surprised, and that's why their trust was less shaken, and they return. Well, the guys that were only watching the state television and really believed everything will be fine, not once it wasn't fine, felt really cheated, and their trust was destroyed completely, and they did not return. So in the end, it turns out that for the long-run stability, telling the truth about the crisis was a lot better than lying. Ultimately, what does it give us? It gives us basically a theory and a model that explains why autocracies, electoral autocracies, usually have less banking crises. But if they happen, they're more severe, more detrimental. Because of this, because of the mechanism. So Russia was not a real autocracy then, it was relatively actually democratic. But they had some, you could say some part of the banks lived in an autocracy, the depositors could only see the state television, and some part of the banks lived in a democracy. And you see that the democracy kind of recovers, and the autocracy doesn't. Yeah. So this is like a within country, comparing two political systems in a sense. Okay, this is very far from finished. The fourth paper I'm not going to talk about because I have only 2 minutes. I'll just show you the title. This is the title. And that one, and maybe I'll show you one slide. No, I'm not going to do that. Whatever, I'm not going to do that. So look, what did John tell you not to do? I'm going to show you one more slide. Wait, no, I'm not going to do that. So forget about it. So basically, I'm going to close the slides. So, but the story of the paper is, it's a very simple story. Remember the Sberbank story I told you? Sberbank was used to get Putin elected in 2000. What we do is, we said, okay, but what about looking at all banks? Because in Russia you have monthly variation in lending to all banks. And we look at 2004, 2008, 2012, and 17, all the presidential elections. What you show is that actually not only the state banks increase lending before elections. All the banks increase lending before elections. And you also see that increasing lending before elections leads to more bad loans after elections for all the banks in every presidential election. So it seems that in Russia, it's not a question of state-owned banks, it's a question of all the banks. All the banks understand that before elections, it's expected of them that they would increase the lending to raise support for the regime. And they all understand it and they all do it. Not in 2000. In 2000 it actually doesn't work. That's the Sberbank story. But from 2004 on, all the banks behave in a politically desirable manner to support the regime. And we show this with many, many regressions, basically. And it comes at a cost of more bad loans and less loan quality, because the lending is politically motivated, so not economically motivated. All right. Officially the end of my talk. I'm really tired, all of you. People do like this, glazing their eyes. But if you have any questions, we can have them over coffee, right? So treat me with questions at the coffee time. Thank you so much.
Thank you. But by the way, at coffee break, we have 10 minutes for questions.
You see, I knew there was questions. Okay, I have 10 minutes of questions, John.
So, I've heard some of this other stuff before, but one point you made, I'm a little uncertain about. You seem to be conflating political connections to banks with politically connected. So, also, for example, you mentioned the Inarcs, as if it's natural that the Inarcs explain connection. But I thought the literature shows that technocrats are less likely to be politically motivated because it's almost, certainly in Asia, the evidence is that the technocrats have a more independent role, partly because it's so guaranteed. And this is related to the literature on term limits, where incumbents who tend to win all the time are less politically motivated. In contrast, in the US, one of the problems with the Congress is they have to run for re-election every 2 years.
Yes.
So they're extremely politically motivated.
Yes.
So I'm not sure you can make a direct link between elites in France and being politically motivated.
Yes. Okay. To answer this, it's a very good question, by the way. But this is not my paper, but it's a very good question for their paper. And I think essentially what the point is with the Inarcs is these guys, their nomination at the top of a company depends on political support. So for example, think about BNP Paribas, when they bought Fortis of 2008, the guy who was appointed at the top of Fortis the first 5 years was one of these Inarcs. And basically it was decided by the president, directly. So many of these big state enterprises and some private enterprises, you see, think of Renault also. Huh? The real decision who will be at the head is actually a political one. So in that sense, I think the system is very different from like Singapore or technocrats in Asia, where there's term limits and relative certainty. So they have certainty about the term in a sense, but not about where they go. And in a way, they are sent by the political center to manage some companies in a like of elite network. And I think that's the idea there of political connection in that paper. Thank you for the question. Paula.
So, thank you very much for this very interesting presentation. It is not my topic, but somehow your the starting point about all the rules in the banking system recalls me all the discussion about regulation and discretion.
Yes.
And moving on with your presentation, we have seen a lot of this interaction between so the political guys and banks. So it seems that the issue is really who regulates the regulator, because if are the politicians that they are setting rules about the discretion of banks, there is something that is not going very well. So because there is a sort of internal conflict. Is this really the point, or I just missed something?
No, first of all, I would say the more general question behind your question is a very difficult one, and nobody can solve it. So it's like the quis custodiet ipsis custodes, right? Even the Romans knew who will guard the guardians, who will monitor the monitors. It's a Roman saying. You see the many buildings in Rome. So it's a question we've never been able to crack. One way economists have tried to crack it is by creating independent agencies.
Yes.
That's the usual solution. That's your question about discretion versus rules. So basically what you say, you create rules, you give people a statute or an official objective, and you make them independent. And that's what John suggests with the term. And that's the usual solution to these problems. However, the system is cracking. So on general terms, and maybe not the direct answer, I think the system is cracking at the seams. Because I think the problem with these independent agents and their limited statutes is that sometimes at a deeper level, what they do and why they do it and their objectives are linked to elite networks.
Yes.
And in a way, what is happening today in Britain and in the European Union and in the US is a kind of revolution of ordinary people against all these independent organizations. Independent judges, why? Independent organizations that do trade arrangements, trade agreements that are bad for me. Why? I want my independence back. So this fight is actually raging at the moment, and we don't know how it will be solved. Specifically for banking, I think it's a very big problem, actually. So I would argue even in the US and Europe, that was the first part of my presentation in a sense, the helping hand. I would say a big part of the regulation is captured by the guys that are regulated. This is not always bad, because the regulator needs information, needs to understand what will be the impact of the regulation. So it's good there is some communication, but there's also in every country some problem of capture, where special interest groups capture the regulation and steer it in a way they want to do it. And ultimately there's no optimal solution for it, I think. There's no perfect world where everything works perfectly. As an economist, I think in terms of trade-offs. So if you make, so imagine you have a bad regime. If you make a regulator very independent, but there's no enforcement on the regulator itself, then he will be very corrupt, most likely. So if they're too independent, so imagine you have a judge you really can't fire. It can work in two ways, right? If you really can't fire a judge, you have the American way, where the judge will be independent and do whatever he thinks. Or you could have the Egyptian way, where the judge becomes very corrupt because he can't be fired anyhow. And that depends on the larger institutional framework. So what I'm basically saying, there is no one solution. There's a trade-off between formal institutions and the trade-off between rules and discretion. And they're interact. So I used to believe as a student, a graduate student, in this rules independent age. I don't believe in this anymore. I think it's contingent. It's contingent on the broader institutional context. These things do not always work, actually. Okay.
The idea I had is just have a look to the regulators in, for instance, energy system, energy sector, whatever, from the UK in the other countries, and you can see how these regulators are independent but somehow connected to the government. But we will.
Yeah. I think you test this idea actually. Yeah, definitely. Yeah.
You speak about the link between bank lending and elections in general, but what's your practical advice for ordinary people, for us, how we should behave with lending, with banks before elections and after?
Oh, there's very little you can do. So you cannot decide the bank lending, right? And in the last paper we show basically all banks behave political in this sense. And it's actually the large banks a bit more than the small banks we show, but basically all banks do it a bit. So you couldn't do anything. Imagine you would be very politically motivated and you say, I don't want to play this game, so I'm going to take my money out of the banks that play it and bring it to banks that don't play it. Like people say, I don't want to invest in this company because it is hurting the environment. So I take my money, I sell the stock and I buy other stock. But in the last paper we show basically all banks do it. So you could take your money out of the bank, but to which bank will you bring it? If you don't want, so you're stuck. So it's a good question. My answer is nothing.
Okay, and final question.
I mean, in the framework of banking and politics, right? Nothing you can do.
Hi, Koen. Thank you so much for this interesting presentation. It's not actually even a question, it's a brief comment. You were talking about elections in Russia, and I was observing Russian elections 5 times, not in 2000, obviously, because I was like 11 years old, but a little later. Yes. And manipulations were crazy. Even in 2008, I'm not sure how clean the data is on like the distribution of votes in 2000. And when you are talking about incentivizing people to vote for someone. So we are not talking about incentives, we are talking about employers telling people that they will be fired if they not take a picture with their ballot, with their check in the right place.
I call this a very strong incentive, actually.
Very strong incentive, yeah, because people didn't have any outside options. That still happens to this day. Like we had that last election, that goes on, especially in regions.
Yes.
In Moscow, it's relatively okay now.
That's what we talk about, actually.
It's
the mechanism. Yeah.
Absolutely, and also you're talking about propaganda. And about media and things like that. I think you're a little bit overestimating capacity of Russian people in general to think critically.
Yes.
Maybe.
Yes.
Because, so we did have NTV, which was independent in times of Leonid Parfenov.
Very independent time.
Yeah, but the question is, would people want to watch that? Do they actually want it? Are they able to process this information? And because like I would try to understand how many people actually were affected by independent media.
Okay, so that is a question or a comment anyway. So basically, what you're saying is in the last paper we only measure whether you can see NTV, but not whether people actually watch NTV.
Exactly.
This is true.
Yeah. And also my friends who were young Russian politicians did some research a couple of years ago.
Yes.
They did this thing that was called propaganda monitoring. And they watch the news and they try to understand how much of it is propaganda. And the percentage is crazy still, like it's 80-90%.
I have a paper on that one too, but
Cool.
we can talk later about this. I have a natural experiment on media freedom. But okay, so on NTV, we don't actually need that the person that's in the bank watches NTV. We only need that some people in that place watch it, because people will talk about it. If you can see NTV in that place, some people will watch it, the information is there, and then through social networks, at least there will be talk, did you hear this? They said there could be devaluation, as opposed to if you're in a region where you can't see it, this information will not run around. And that's the difference. So we do not need that the individual depositor watches the NTV. We only need that he's exposed to the information directly by watching, or indirectly by someone talking to him about it. And that's going to be, the indirect channel is going to be stronger in those places where you actually can watch it. And that's what we need, essentially.
Okay, thank you.
That's awesome. Thank you.